If you are still taking crazy losses or blowing your trading account, then you need to listen very carefully because I'm going to be revealing the secret to protecting your hard-earned money whilst maximizing your profits in the Forex market. So be sure to stick around because by the end of this video, you will have the best tools and the best knowledge to transform your trading game and achieve consistent, sustainable success. So in this video, I'm going to reveal the best system that can help you to protect your capital, increase your profit, reduce stress, and trade with confidence. Imagine this for a second. You are making trade and then taking profits and then feeling confidence and then boom, a sudden market shift happens. Your entire account is wiped off. That is every trader's worst nightmare. But guess what? It doesn't have to be yours. Welcome back to my channel. If you are new here, I'm your host, Baby Forex, and I like to share trading tips, strategies, and knowledge to make you a better trader. And in today's video, we are diving into the secret sauce that separates the successful Forex traders from the rest, and that is effective risk management system. So whether you are a seasoned trader or you are just starting out, mastering risk management is your #1 ticket to sustained success. So in this video, I'm going to reveal the best system that can help you to protect your capital, increase your profit, reduce stress, and trade with confidence. So stay tuned because by the end of this video, you will have a rock-solid risk management plan that will transform your trading journey. If you are ready to take full control of your trading success and make smarter trading decisions, smash that like button and subscribe to this channel right away. And finally, grab a pen, grab your favorite notebook, and let's get to work. So just as we begin, the first thing I would like to address, which is actually very important, is for us to understand what the risk management actually is. That is very important. So what is risk management in Forex trading? Risk management in Forex trading is the process of defining how much of your trading capital you are willing to risk on a single trade, and also implementing the right measures to limit potential losses and also employing strategies to optimize overall trading performances. So that is simply what risk management is. It's all about employing the right system, the right strategy to help you minimize losses and maximize your profit potential. And that is very important if you are trying to trade for a long term or you are taking your trading as a full-time business. You need to take risk management very important because without risk management, it's only a matter of time before the unfortunate eventually happens. So risk management is an essential aspect of successful Forex trading. It involves a combination of strategies and tools designed to minimize losses and protect your trading capital. By effectively managing risks, you can enhance your chances of long-term success in the Forex market. So that is very important. So the next thing I would like to quickly touch on is what are the common mistakes that traders make in risk management, right? The common risk management mistakes that traders make. So the first mistake that most traders make is over leveraging, right? And another mistake is poor position sizing or poor lot sizing, not positioning your lots the right way, or trading with the wrong lot sizes. Another mistake could be ignoring stop loss order, not using stop losses, or not following a trading plan, or also chasing losses or revenge trading, neglecting diversification, ignoring emotional control, failing to adjust to market conditions, and unrealistic risk to reward expectations. These are some of the mistakes that a lot of traders make when it comes to risk management. And from this point here, you would understand that a lot of traders fall into this category, right? You may not make all of these mistakes, but you might be making 1 or 2 or 3 of these mistakes. So if you are able to identify what the mistakes that you are making, is going to help you to figure out what you need to do to solve that mistake, right? So let's also go on to why is risk management important in Forex trading? So it is not right to discuss risk management without highlighting why it is actually very important to your success in the Forex market. So let's look at why it is actually very important, why it is actually very crucial for your success in the Forex market. So risk management is crucial in Forex trading for several reasons. And all of this revolves around protecting traders' capital and ensuring long-term success. And the first point on my list here is capital preservation. Capital preservation. And this includes avoiding large losses and surviving drawdown, right? When you apply the right risk management, you are able to avoid large losses and survive a huge drawdown, right? And the other points on my list here would be emotional control. So emotional control has a lot to do with risk management because it helps you to reduce stress and anxiety, and also it helps you to also maintain discipline. If you have emotional control, it has a lot to do. It has a lot of impact on your discipline and also managing your stress level and your anxiety when you are trading. And another important why you should apply risk management is the long-term profitability, and this is actually what we all want. This is the main goal of every trader who is serious about this business. And when you look at long-term profitability, it involves giving you the ability to have consistent growth and also optimizing your risk to reward ratios. So all these are given to you by implementing a good risk management system. And another point I can think of is building confidence. When you have the proper risk management system in place, you are able to build your confidence. And confidence also goes in line with your trading plan. Likewise, it helps you to keep an open mind to learning and improving on what you do. So it helps you to build your confidence the right way. And another point on the list here is avoiding over leveraging. So when you have a good risk management system, you are definitely going to manage your leverage the right way. You are not going to over leverage your account, which means you are not going to expose your account to so much risk. So the chances of you losing your account is actually very minimal, right? It is almost non-existent when you apply the right and the proper risk management system. And another thing I can add would be protecting you against unpredictable market events. So there are times where you have some sharp moves in the market, some high volatility events in the market, or fundamental impact that causes some sharp moves in the market. So if you have the right risk management system in place, you are able to survive those kind of unexpected movements or volatile movements that may happen that could have probably ruined your account if you hadn't paid any attention to risk management. So this is actually very important. And the last point I can add to this list would be professionalism. So when you apply risk management, it helps you to trade like the professionals. When you look at the top traders, they are very particular when it comes to risk management. So if you are trying to trade like the big boys, then you have to take risk management very seriously. If you have a big account size or a big portfolio you are managing, then risk management should be the priority on your list. So it is actually very important. So risk management is the backbone of successful Forex trading. It's not only protect your capital from significant losses, but it also enhances your ability to trade confidently and consistently over the long term. By incorporating risk management into your trading plan, you can navigate the Forex market more effectively and increase your chances of achieving sustained profitability. So that is absolutely important. So the next point I want you to know when it comes to understanding risk management is what I call risk tolerance. Risk tolerance. So if you're ever looking at having a proper and solid understanding of risk management, one of the things that comes to your mind is the risk tolerance. So different people with different risk tolerance. So how do we explain risk tolerance? So let's have a quick explanation of that. So risk tolerance refers to the level of risk a trader is willing and able to take when trading in the Forex market. It is a measure of how much potential loss a trader can endure in their Forex trade. So understanding risk tolerance is crucial for creating effective risk management plan that aligns with your financial goals, your emotional comfort, and overall trading plan. So the key point I want us to take note of is creating effective risk management plan that aligns with 1, your financial goals, 2, your emotional comfort, and 3, your overall trading plan. So risk tolerance is absolutely important. You need to take it very seriously as well. So it all boils down to your level of comfort in taking risks. So different trader has different level of comfort. So there are traders who are comfortable with taking about 5% loss. There are traders who are comfortable with taking 20% loss. There are also traders who are comfortable with taking even more than 20% loss. So you need to define your level of comfort and trade within your level of comfort. So trading with a minimal risk exposure does not mean you are going to make minimal profits. That mindset is absolutely wrong. So you can expose a little of your accounts to loss and still make good returns on your account. And I'm going to touch up on those points as well. So now, what are the key elements when it comes to effective risk management system? So if you are looking to have a very good and solid risk management system, there are these 4 points that you need to know. There are points that comes to mind that you absolutely need to put into consideration. And these are 4 major elements of an effective risk management system. The first point here is the right position sizing. The right position sizing, that is the first point. The second point is the right stop loss orders. Stop loss orders is the second point. The third point on the list is risk to reward ratios. Risk to reward ratio. And the last point on these 4 key points you need to create a solid risk management strategy is diversification. Diversification. And I'm going to explain these 4 points so you are able to incorporate them correctly to create a solid trading plan that you can use and depend on to grow your account for the long term. So the first point on the list here is position sizing. Position sizing. So let's also look at it this way. So position sizing refers to determining the amount of money to trade in a single position based on your total capital and risk tolerance level. So it prevents significant losses on any single trade and helps you to maintain a balanced risk exposure across multiple trades. So if you are trading multiple trades or multiple markets at the same time, when you have the right position sizing, it helps you to trade the right amount of lots across board, right? So it also protects your risk tolerance and also protects you from taking any major hit, even if the market goes against you. So position sizing is absolutely very important. And I'm quickly going to show you how you can determine the right position sizes you should be trading based on your account size. So this is absolutely very easy to do. And we have several position size calculators that you can use on the internet. And a lot of trading platforms also provide position size calculators that you can use to determine the right position sizes for your trades. So I'm quickly going to show you the position size calculator that you can use. This is one by my FX book. There is a position size calculator offered by my FX book, and trading platforms also comes with position size calculator. Depends on the ones that you use. So if you are trading with sway markets, the sway market broker, I talked about sway markets, there is a position size calculator that comes with it, and I explained it. You can check the video here or here. You would find a video where I explain how to calculate your position size, and I'm quickly going to show an example on this free calculator here on my FX book. So when you have something like this, you simply pick the pair or the currency that you want to trade. So let's say we have EURUSD, and you select your currency. The next thing here is to select your account size. Your account size, let's say you have a 10K account, and then your risk to reward ratio or risk ratio here. Okay, let's swap it. So risk ratio here, you want to risk about 5% of your account to risk, right? You have 5% risk in this case. That is your risk exposure level. So your stop loss by pips, if on that trade you have 40 pips stop loss, you type it right there, and then trade size or lot size, that is 1, and then you leave it as 1, and then you click on calculate. So This is simply going to tell you the lot size you should be trading, that is going to provide you the right stop loss to use, and also give you the right position size and risk to reward for that particular trade. So over here we have 1.25 lot size. That is the lot size you should use for that very trade. And then your risk on that trade is 500. Remember, this is 5% of 10,000. So your risk on that very trade is 500. So the right lot size for that trade is 1.25, and with 1.25 you are able to have 40 pips stop loss. You are able to have a 40 pip stop loss. So by using this position size calculators, you are able to determine the right amount of lot size or position size that you should be trading any single time. So that is actually very important. So there are other platforms that offers these types of calculators that you can check out, and then be sure you have the right platform and the right settings to correctly give you the right lot size that you should be trading. So that is very important. So let's go on to the next point on the list, which is so the next point on the list is how to use stop loss effectively. How to use stop loss effectively. So what are stop loss? Stop loss orders are used to protect your capital against unexpected market movements, and they ensure that losses are kept within an acceptable limit. So if you are trading without stop loss, it is actually a very bad habit. If you are ever trading without using stop losses, it is a very bad habit, and it is only a matter of time before the unfortunate happens. So stop loss are actually very important, and I'm going to show you how you can correctly determine the type of stop loss to use, or how to determine the right stop loss to use for your trade. Quickly, if you are enjoying this video so far, be sure to take a moment to hit that like button, subscribe to this channel, and also turn on the bell icon so you never miss out on anything that we put out. So let's quickly delve in and look at how to use the right stop loss on your trade. So stop loss, like I said, is meant to protect you from taking unacceptable losses, right? So if you have this is my trading platform, so let's make a quick illustration on that. So if I was going to place a trade on pound USD, if this was going to be a sell, right? So this may be different from different platforms, but if you're on Sway Market, my recommended broker, I've talked about this broker several times. It's very advanced, and it makes risk management application very easy and super fast for you to apply. So if you have Sway Market, it depends on the Forex broker that you are with. So to apply your lot size, you can easily apply lot size right here. So we are looking at stop loss, right? So if you have determined your stop loss already, you can simply type it right here. And another way to also determine your stop loss with this powerful platform that I'm using is by simply dropping down right here, and then you can check right here. So you can set your stop loss based on the percentage of equity. So if I want to set my stop loss by using my percentage, so if on this trade I want to use 5% of my account, all I need to do is to type 5% right here. So automatically, this powerful trading platform is going to set my stop loss based on 5% of my trading capital in my account, right? So this is one of the reasons why I always recommend this very broker and this platform that I currently use to trade. It is called Sway Chart Pro, right? And it is offered by Sway Market. So you may check the link in the video description to sign an account with Sway Market to have access to this powerful platform. So this makes it very easy for you to apply your risk management. So if you are looking to use just 5% or 2% of your account per trade, it depends on your risk tolerance, and it depends on your risk exposure that you want on your account. So if per trade you want to expose just 5% or 2%, all you need to do is come right here and select percentage of equity, and then you are good to go. And there are other ways you can also set your stops by using pips, by using price level, by using percentage of balance, by using cash risks. You can also use cash risk. So if you have 1,000, you may set a stop loss of maybe $100. That will be 10%, right? If you had 2,000 on your account, on your capital, you can set a stop loss of maybe 200, and that would be about 10%, right? So it depends on how comfortable you are with any of these parameters, right? So you have different ways to set your stop loss, and this absolutely makes it very easy. So if you are very comfortable with your percentages, you can use percentage of equity. So this depends on the level of equity in your account. So your stop loss could be 5% of your total account, or probably 10%, depends on your risk tolerance. So you simply type that right here, and then you can use that to place your trade. And also you can set your TP as well with the same parameters, right? You can set your TPs with any of these parameters, and then you place your trade right there. So that is simply how easy it is to set stop loss the right way, without having to stress yourself with going over to position size calculators or any of that. So with this platform, it makes it super easy to do all this in just one place. So that is a plus for those who are trading with Sway Market and on the Sway Chart Pro platform. This is a super powerful platform. You can check the link in the description to get access to this platform. You can also watch the video I created about this platform, explaining everything about it right here, or check the link or the channel. You find the video and then you can go over it. So the next point on the list I would explain is what is risk to reward ratio, right? So risk to reward ratio is another element when it comes to the 4 key elements to creating a perfect risk management system, right? So if you're looking at risk management system, you need to consider the right position size, you need to consider the right stop loss, you need to consider the right risk to reward, right? And this is very important. So what is risk to reward? So the risk to reward ratio is the ratio between the potential profit of a trade and the potential loss. It helps in evaluating the potential profitability of trades and ensures that profit potential outweighs the risks, right? It helps you to know that the potential for making profits on a trade outweighs the risks, right? So that is the risk to reward. So a lot of time you'll find something like 2 to 1, 3 to 1, 4 to 1, 5 to 1, right? So this simply tells you that if you are looking to risk about $100, you should be targeting to make no less than $200. If you are looking to risk about $1,000, you should aim to make no less than $2,000. So I always recommend 2 to 1. The minimum should be 2 to 1. If you have $100 at risk, you should try to make $200 from that trade. So this has a lot to do with the type of setup that you are trading. It has a lot to do with the technicals on your chart. It has a lot to do with the technicals on your chart. So let's make a quick example of a trade on this chart. So let's say, for example, on this chart right here, you are looking at you are looking to take a buy from this very low, and then you are looking at something like this. You are looking to do something like this. So your risk to reward in this case should look somewhat like this. So the red here, the red icon over here tells you the risks you are looking at. So if, for example, on this trade, you have 25 pips stop loss. So this here is your stop loss, right? This here is your stop loss. And let's say your lot size you are trading is a 1 standard. So 1 standard lot size, and then you have 25 pips stop loss. So a 25 pips stop loss, that is $250 at risk, $250 at risk. So the risk to reward in this case tells you that if you have a buy right there, your TP is all the way up here for about almost 90 pips. Let's make it 90 pips. So your TP is all the way up here for about 90 pips. So you start to make 900 whilst you have 250 at risk. So with that, you have a risk to reward of about 3.59. 3.59, almost 4 to 1. This is very close to 4 to 1. This is very close to 4 to 1. So you have 250 at risk, and then you stand to make 900. So the risk to reward ratio is 3.59. So like I said, the minimum you should look at is 2 to 1. If you have 250 at risk the minimum you should aim for is 500. If you have 250 at risk, the minimum profit or target you should aim for, and this depends on the setup and the technicals on the chart, right? So you cannot just set unrealistic targets, right? You have to set your targets based on the technicals on the chart. So when you look at the setups you are trading, depends on your technical approach, depends on your understanding of the market trends, your key levels on your chart. You should be able to find setups which gives you 2 to 1 or more. You should be able to find setups that gives you 2 to 1 or more. So that is the key point to take home from this. So 250 at risk, and then we stand to make 900. That is almost 4 to 1. That is almost 4 to 1. So this is absolutely good. So that is a good setup to look out for. So your risk ratio is very good. The risk to reward ratio is very good, and that is simply how to look out for the right trade. So you should not have a situation whereby you have 1 to 1. So if you have something like this is 1 to 1, right? So the stop loss here is 37, and the TP here is 37. So this is a 1 to 1. This here would be a bad trade. So 37 pips, 37.2, 37.2. So this is definitely a bad trade. So a good trade would be when you have something like this. Your stop loss should be a lot smaller than your profit. This is the risk region. This is the profit region. So the risk region should be a lot smaller compared to the profit region. And that is where you have a good risk to reward in place. So you need to apply good risk to reward every single time, and you make sure your risk to reward gives you no less than 2 to 1. No less than 2 to 1. So if I would have a good risk to reward right here, probably if I have a 30 pips stop loss, I should be looking at a possible 60 pips or more. From 60 pips or more, I'm good to go. So I should aim to make 60 pips or more. So the main thing you have to do here is to look out for those setups that gives you a good risk to reward. So if you have a good setups, but the setup does not offer you a good risk to reward, it is not a good setup. So any setup which does not offer you a good risk to reward is not a good setup. You have to skip and look for a better setup. So that is what you need to know when it comes to the risk to reward. And the next point also on the list is what I call diversification. Diversification, and this is also very important, how to diversify your portfolio. So diversification involves spreading your trades across different currency pairs to reduce exposure to any single currency pair's risk. So this reduces the impact of negative movement in any single currency pair and balances overall capital risk. So let's go over that again. Diversification involves spreading your trade across different currency pairs to reduce exposure to any single currency pair's risk. So this reduces the impact of negative movement in any single currency pair and balances overall capital risk. So you need to trade a mix of majors, minors, or exotic currency pairs and avoid over-concentration in correlated currency pairs. So this is very explainable, this is very understandable. So you need to avoid trading markets of the same family. I always explain to my students that when you're trading, avoid trading currency pairs of the same family. You have trades on USD JPY, and then at the same time you are trading EURUSD, you are trading USD, you are trading AUD-USD. These are markets which has correlation in common, right? So you need to diversify your trades across markets which are not correlated that much. So that way you reduce the chances of going negative on all markets at the same time. So diversification is absolutely very important. It helps you to limit your chances of risk on those pairs which are from the same family, right? So that is absolutely very important. So watch out for diversification when you are planning your risk management system as well. And you need to be very selective when it comes to the right type of market that you should be trading. You may also check this video that I made explaining how to pick the right Forex market currency pair that you should be trading. Picking the right pair absolutely matters a lot, and diversification is very important. So I explain in details how to pick the right currency pair in this video up here, so you may check it out and understand everything about that. So the next point, so when you apply everything I've explained so far, the 4 key elements of a good risk management system, when you apply it correctly, you are absolutely on your way to having a very profitable trading career. And one of the key points here I want to highlight is the risk to reward system. When you have a proper risk to reward system, you make it very, very, very difficult for the markets to clear your account, to blow your account. You make it very tough for it. So like I said, you need no less than 1 to 2 risk to reward system. If you have a 1 to 2 risk to reward system, you do not need to win most of your trades to be a profitable trader. That is, if you have just 2 to 1, all you need to be a profitable trader is to win 40% of your total trades. By winning just 40% of your total trades, you can be a very profitable Forex trader, right? So now imagine what is possible when you have 3 to 1 risk to reward, when you have 4 to 1 risk to reward, or even 5 to 1 risk to reward. So this depends on the types of setups you are trading and also your type of trader, the type of trader that you are. If you are a day trader, swing trader, long-term trader, you can even make more than that. You can make more than 4 to 1, more than 5 to 1. So it depends on the type of trader that you are. But on the minimal 2 to 1 risk to reward system, all you need is to win just 40% of your trades to be a profitable trader, right? So you could be losing more trades and still be a profitable Forex trader. That is the power of a risk management system, the right risk management system. So I have an example right here which says on a $1,000 account, and by trading 0.20 lot size and with a 40 pip stop loss and 80 pips take profit. So at the end of the month, this means if you lose 80 bucks per trade. And if you win a trade, you make 160 bucks per trade. So if you lose 60% of trades, this means that you lost 480 bucks, right? If you lose 60% of all your trades, it means that you've lost 480 bucks, right? That is $80 per loss, right? And if you win 40% of your trades, it means that you won 640 bucks, $640. So 640 minus 480, right? You have 160 net profit. So at the end of the period, you are able to make 16% gains for that month. 16% is not a small number. When you are trading like the big boys, if you have a good account size, probably a 5 figures, 6 figures, 16% at the end of the month is not a small number. It's a big figure, right? This is what a lot of banks are offering you guys at the end of a full year, a full 12 months, a year, right? So if for example, on the 50-50, that is, you won 50% of all your trades. So let's say on 100 trades in a month, you won 50 of the trades and you lost 50 of the trades. So at the end of the period, you would have won about 800. You would have won or made 800 and you would have lost 400. So at the end of the period, you have made $400 profit. So which translates to 40% gains for that month. So now imagine what is possible when you win more trades than you lose, right? If you win more than 50% of your trades, if you have a very good trading system, for example, like what we trade in my mentorship program, we are able to win over 80% of our trades. On a regular, we are able to win over 80% of our trades. So if you have a very solid trading system that gives you a very good hedge and a very good winning curve, you should be able to have more than 70% win rate. So if your win rate is actually very high, and then you have a very good or solid risk to reward ratio, your profitability in the market is going to be through the roof. It's going to be very, very, very super crazy. So imagine what is possible when you win more than 50% of trades on a 1-to-1 risk to reward ratio. Or if you can imagine what is possible when you have 1 to 3 or even 1 to 4 risk to reward system with a very good trading system that offers you a good win rate. So imagine what is possible with that. So it makes it actually very impossible for the market to take your money or even blow your account. And as I've always said, this is 2024. You should not be blowing your account in this year. If you are still blowing account, then definitely the fault is on you. The joke is on you. There is absolutely no reason for you to be losing your account or blowing your account in this year with all the information at your fingertips. You need to apply the right system, apply the right knowledge, and you're definitely going to be very profitable in the market. So instead of trading like a machine gunner, learn how to snipe the best opportunities that lines up with your rules of engagement, quality over quantity every single time. This is absolutely what I preach in my mentorship program. Look for the best trade that lines up with your trading system and you should be good. So it is not about how much you can make. It is rather about how much you can keep. Consistency is key. So apply all this with everything I've mentioned, and definitely you'll see a good change in your trading. So that is absolutely very important. So by combining these 4 points that I've just explained, you'll be able to create a very solid risk management system by understanding your position sizing, understanding your right stop loss orders, understanding your risk to reward, and understanding your diversification. So like I said, for the position size, you can use calculators, your online calculators, to determine the right position size that you should be trading. You have no business trading just random lot sizes every single time you're trading. You need to be very specific on the right lot size that you want to trade. And like I told you earlier, your lot size has a lot to do with your risk tolerance. Your position size has a lot to do with your risk tolerance and then your total capital balance in your account. So you need to factor those points and determine the right position size that you should be trading. Also, you need to use stop loss. Every single trade you open, you need to open a stop loss order as well. If you are trading without stop loss, it is a very, very bad habit. It is a very, very bad habit. You need to snap out of it as soon as you can. And the other point, like I said, is risk to reward. Always apply risk to reward to every single trade that you take in the market. It is absolutely very, very important. And the last point, which is diversification, I've explained that. So you need to combine all these 4 points to create a very solid and robust risk management plan that is going to keep you trading and trading profitably without blowing your account or losing your account or taking a major hit on your account in the long run. And this is going to ensure that you have a sustainable trading for the long term. So this is very important, and I hope you learned something from this video. So take a moment to give a like, give a thumbs up, drop your comment, subscribe to this channel for more updates. If you have any questions or anything in mind, you may drop your questions in the comment section. I will definitely get in touch to address all of your questions as soon as possible. So all the questions should go in the comment section, and share this video to as many people as you know, because definitely it's going to save a life. It's going to save a trading account. So avoid blowing your account. And I know this video is going to help a lot of you from blowing your account. So apply everything you've learned from this video, and then I'm sure definitely you will have good experience and good results going forward in your trading. That'll be all for now. Thank you for joining me in this far, and see you on the next one. Bye.